kick it off here because there's a lot of uncertainty with what's going on in society, and rightfully so. We don't know what's going on, and we don't know what's going to happen either. So it kind of makes people a little bit nervous, and I think they have a good reason to be nervous. So let's talk about the market and in general the economy. Do you think we're going into a depression?
Well, I would say depression would be a strong word. Recession, yes, for sure. And we can talk about depression, but recession, absolutely. And in fact, we're in a recession right now. We don't necessarily realize it, but when you look at some of these job numbers coming out on Thursday mornings, it's pretty noticeable right now. There's a big difference between a recession and depression. So let's just talk about, because this has been coming up quite a bit with clients. And so I think there are some important distinctions to make today when you compare it to what happened in the 1930s. So today you have a Fed, the Federal Reserve, who is basically stepping in and become the buyer of last resort. They are extremely, extremely accommodative. Interest rates are zero. That is a huge distinction between today and the 1930s. And in the 30s, the Fed, which was actually very young back then, and so they were probably, I would imagine, trying to figure out exactly what their role was in the economy in the U.S. And they actually tightened monetary policy, which is the complete opposite of what they're doing today. Okay. So that in and of itself is a huge, huge distinguishing factor to help us avoid a depression-like scenario. Yeah. Also, taxes were actually going up. Tax rates increased around the Depression versus today, tax rates are pretty favorable. And so I think those with some other things like trade war, yes, we have a trade war today. It's not nearly as dramatic or extreme as what was occurring in the 1930s. So I think that, despite, ultimately, I don't know if we would go into a depression, but if you just look at the underlying fundamentals and what the Fed is doing, it's hard to make an argument that we would see a depression. But even still today, seeing these job losses, it's very unfortunate. And you just have to hope this is all very much a temporary situation that we're in right now.
Yeah, and I think that there are some distinguishers between then and now, in the sense that the unemployment is just going to be skyrocketing. You and I talked about this earlier too, about the amount of small businesses that are going to go out of business. Commercial real estate's going to drop through way down. There's a lot of things that we don't know exactly what's going to happen until maybe one of the next quarter or even 6 months. We don't know for sure. And it's easy to say that too, but it's hard to not just wait and see, essentially. But there are some major differences, especially in the unemployment claims from then until now. Is just no contest in comparison. Right. So, and I think so. What's the benchmark for a recession versus a depression, percentage-wise? That's usually how it's gauged, correct?
Yeah, I mean, a recession is so the definition of a recession is basically 2 consecutive quarters of negative GDP, or gross domestic product. And so this first quarter, the first quarter of 2020 will probably, I don't think will be negative, but the thing is, going into this, GDP was already somewhere between 2 and 3%. So on the positive side, when you have this shutdown, you're going to see a technical recession. You're going to see GDP turn negative second quarter, third quarter. And in a depression, it's something dramatically worse. We're talking a contraction of 10+% plus unemployment numbers substantially higher than even what we're experiencing today.
Okay. Well, and that all makes sense too. I think, again, it's a weird thing too, because we're not necessarily seeing the typical indicators of like the sky is falling. One thing I was going to ask you is that we've seen 22 million-ish people on unemployment, maybe a little bit higher now, but stocks are going up. So that usually does not, like they're not usually the inverse. So can you talk about that a little bit?
That is that also has been coming up quite a bit when talking with clients right now. And it's a bit of a conundrum, to investors, is how can you see a market which did, granted, let's just say, looking at February into March, stocks did drop. Look at the S&P 500, the large cap US index, it dropped approximately 35%. And that occurred over the course of about 17 trading days. So basically 3.5 weeks, which was actually the quickest decline of 30 or more percent that we've ever seen in the history of the stock market. So, but since then, we have seen a pretty nice bounce back in stocks. And the bounce started occurring right around the same time that the unemployment claims really started to skyrocket. Mm-hmm. So the question is, why is the market going up? I mean, this is complete speculation. Yeah. No one truly knows exactly why. Sure. But if you look at historical recessions and historical bear markets, which we are in a bear market, and bear market is defined as a drop in stocks of 20% or more from their highs. Yeah. So we did obviously have that. So you oftentimes do see a bounce once you hit extreme pessimism. And the third week of March, we did hit extreme pessimism. And so at that point, it's a natural reaction to see buyers come in and basically swoop up stocks that are what they believe are cheaper than what they should be. Mm-hmm. And you then have more technical factors, which we won't necessarily get into today, but you have people that are betting against the stock market, meaning they profit if the market goes down. And as soon as the market starts going up, they have to basically get out of their position, and them getting out also induces a rise in the stock market. Yeah. And I will also add too, is that one of the expectations with all of this, with the coronavirus and the economic shutdown that we're experiencing today, is that, and this is an expectation, big difference between expectation and what actually happens. But the market today, collectively, the stock market, is expecting this to be a quick recovery or a quick rebound. And I'm hearing a lot about V-shape recovery or U-shape recovery. Basically, if you look at a V, if you look at a U, exactly how does the recovery look? And over the last 10 years, since the economy started expanding out of the financial crisis, you had a couple instances where the economy did start to slow down. The Fed stepped in, as they did today. They became even more accommodative with lower interest rates, and the economy V-shaped recovery out of it. Okay. And today, that is still the expectation. So if that is true, and if you look at historically, when do stocks bottom before the end of a recession? So let me explain this. So let's assume that we are in a recession right now, which, like I said, I believe we are. Yeah. Typically, the stock market starts to recover about 5 months before we exit a recession. Okay. So it's natural to see stocks start to rise in conjunction with these technicals that I talked about. But it doesn't make sense, because you look at all these unemployment claims coming in, and it feels like the stock market in a way is somewhat disconnected from reality. Yeah. And
it's not correlated to what you see in reality right now.
Yeah, because the stock market is very much a forward-looking indicator. The stock market is it's trying to look past this whole situation and say, yes, this is an unfortunate circumstance we find ourselves in today. It's temporary. We believe the economy and the market is going to recover quickly once things start to open back up. Yes, there will be some folks that are unemployed longer than they themselves want to be. But ultimately, it's short-lived, and the economy will start to recover in short order. Now, last thing on this is that, let's say that we do start to reopen, right? And folks are starting to go back to work. I just saw today that the park by my house is reopening. And so so that's all positive. And so the market is also reacting to that. Mm-hmm. Now, here's what's really important, is that let's fast forward, 2 months, and the US economy, and we're all kind of getting somewhat back to normal life. If we start to see a spike in virus cases,
Mhm.
and then we have to kind of retreat back into some element of a shutdown. Then the stock market is going to have to reassess its own
Yeah.
expectations. And then we're going to continue to see more volatility and probably test the lows, and who knows from there.
Yeah, that makes sense too. If we reopen back up and then we have more outbreaks, and I could see us going down a lot further too. And we have plenty of room to drop because it's been the longest bull market in the history of our country, correct?
Mm-hmm.
So
Yep, that's true.
we have some room to drop. So before we move on to the next question, I had some questions that were emailed in. Hi Joe, what safe place can this 67-year-old San Diegan put money, which will keep us up with actual inflation? Someplace liquid and fairly accessible. All I could think of are short-term CDs.
Yeah, it's a very good question, and something that's has been coming up obviously quite extensively with clients. So this is not advice. Here are a couple ideas for you. Okay, now CDs. Well, let's take a step back and talk about inflation for a minute, right?
Yeah.
So we saw yesterday something that we've never seen in the history of the oil market, where we saw a barrel of oil actually trading at a negative price, which is just kind of mind-blowing in a way. Now, oil in and of itself is a big component of inflation, and oil, as low as it is going to be one factor that keeps inflation down. Now, I know everybody's personal inflation gauge is not exactly tied to what is solely tied to the barrel of a barrel of oil or the gallon, the cost of a gallon of gas, but we have healthcare costs that are going up. There's other areas of our life that are increasing even more rapidly than inflation. So in terms of investment strategy, what individuals should be doing now, I mean, it's a very personalized situation,
Sure.
but I will say for somebody that's 67 years old, I don't know if this person's retired or still employed, but let's just assume that he or she is retired today, and they are utilizing their retirement nest egg to fund their life to a certain degree. Maybe they have Social Security, maybe they have a pension. So what's first and foremost most important is to understand where your cash flows from that investment, where the cash flow is going to come from in the short term. And what I mean by that is that money that you need tomorrow from your investments, or money that you even need 3 years from now, may not be best suited in the stock market right now. If you look at your different buckets of money, use that concept. You have your today bucket, you have your 0 to maybe 3 year bucket, and then you have your 3 to 5 year bucket, and then beyond that, and then beyond the 5 years, that's where you could take risk in the form of investing in the stock market. So to try to answer this person's question, for somebody that is concerned about inflation, despite the ups and downs of the stock market, if you believe that, yes, we're in for short-term pain, but over the long term, stocks are going to recover, the stock market is still a good place to put your money despite the short-term uncertainties.
Yeah.
And then for those funds that you need in the short term, CDs is one place, but you're very well not going to keep up with inflation depending upon your personal inflation gauge, just because the interest rate environment, like I said, the Fed has cut rates to 0. The banks all follow suit with cutting their own rates because everything is tied to what the Fed is doing. And so you can put your money in something like CDs or even short-term treasury bonds, where your capital is secure, but over time you probably will not keep up with inflation. And that again gets back to why you still need to be invested.
And that's a bit of a cost-benefit analysis you need to do with these investments, it sounds like, because you might take a little bit of a hit on a couple of percentage points over time, but it's going to be more safe. If you want to be a little bit more, risky and go for it, then you can definitely find some places to get higher percentages. But overall, it just depends on, your stat. I know everyone is very different too. And I just wanted to ask that question, that email, because, and I know that you want to give a more customized analysis depending on the person, because that advice, or that wasn't advice, but that information that you just gave doesn't work for me. It doesn't work for
Right.
you. It doesn't work for someone who's 62. You know, it's highly personal, and that's why it's important to speak to someone who is a professional and someone who can do an analysis on you as a whole. And I know you focus, one of your main focuses, Joe, is retirement. And I think that it's so important to have a plan in place. And as you know exactly what we do. We've known each other for a very long time. And you do what I do, just not on the legal side. You do it on the financial side, making a comprehensive plan and making sure that's in place. And I can't stress enough how important that is. And I'm talking to you, anyone who is watching right now on Facebook or on Zoom. And we're going to make this video available too, so you can kind of review it afterwards or send it to your friends or family, because this is some pretty good information about what's going on. And I have some more questions, Joe. Of course, I'm sure you knew this was coming. The $2.2 trillion stimulus package, this included a lot for a lot of different sectors, including small business, which it sounds like we're going to be doing another round, an extension of that. We were talking about that this morning as well. Let's first talk about the minimum distributions for people over 70 and a half. And also, I remember hearing something about you can borrow against your retirement plan without penalty, or you can withdraw early. What was going on there?
Yeah, so there's a couple things. And by the way, I saw prior to jumping on this with you is that they are very close. They being Congress is very close to passing. I think it was $430 billion in additional funding for small businesses, and that's a part of it. That's a major part of it. I'm sure there's other stuff in there, but that should be passing very soon. I would say in the next day or two.
Good.
So, so let's talk about the CARES Act is what it's called, the $2.2 trillion stimulus that passed a couple of weeks ago.
Yeah.
The $2.2 trillion it's a hard number to wrap your brain around.
Yeah.
Okay.
Yeah.
There were many different components of it. A lot of it went to small businesses. There was a part of it that went to the airlines and some other travel industries that are most severely impacted by the situation. Mm-hmm. And so small businesses have access through what's called the PPP. It's a loan that's forgivable if the funds are used appropriately based on what was stipulated in the bill, among other things. So let's talk about what's specifically in terms of the retirement, what they did there. So for those that are over 70 and a half, and although caveat, this actually changed. See, this is another reason why working with a professional becomes really important, because at the end of 2019, Congress passed what's called the Secure Act, which going into 2020 was something, even at the end of February, that I was trying to personally wrap my brain around what exactly this means for my clients, because there were so many little nuances in the Secure Act. The Secure Act was actually something that had been discussed and potentially it was almost passed, and then they pulled it on many different occasions. And at the last minute on December 19th, out of nowhere, the Secure Act passed. Yeah. And one of the big changes that occurred as a result of that was that for those that are in retirement or maybe you're retired, maybe you're not, but for those that are turning 70 and a half prior to the Secure Act, that was when you needed to start taking required minimum distributions from retirement accounts. Mm-hmm. So like an IRA, for example. But the Secure Act actually changed the required starting date for RMDs, or required minimum distributions, to 72. So let's just say you're 73 years old and you are taking a required minimum distribution from your IRA. In 2020, Congress eliminated the required minimum distribution. Mm-hmm. So for those retirees that do have money in the stock market, obviously their portfolios are probably down to some degree. And so as a part of this package, they basically said that you do not need to take a required minimum distribution in 2020. So it opens up planning opportunities for folks that were planning on taking that required minimum distribution, because this year, if you don't need it, if you have the luxury of not necessarily needing that required minimum distribution, mm-hmm. there are other planning opportunities to take into consideration, because your taxable income may be lower this year. Yeah. So that was one part of it. Required minimum distributions no longer required for 2020. Another part of it was for those that are experiencing financial hardship as a result of the coronavirus, whether that be you were laid off, maybe you were actually diagnosed with COVID. There are a number of stipulations that, and I would imagine that the IRS is going to be fairly lenient on this. But number one was that you could, for those that are under 59 and a half, by the way, you are penalized for taking money out of your retirement accounts. You pay a 10% penalty on top of federal taxes and California, if you're in California, California state income taxes. So on top of those two, you also pay a 10% penalty. But one of the other things that passed with this bill was that 10% penalty is waived if you need to take money out of your retirement account as a result of being impacted by this virus.
So they have to be connected.
There has to be a connection, and how are they going to make that connection? You know, that's not for me to figure out.
Yeah.
You can, so that was one of them. You can also take a loan, if you want to call it that, against a retirement account, basically pay it back over 3 years. So take a retirement distribution today and pay it back within 3 years and not pay any tax or any penalty. So it's a way to access funds from your retirement account on a short-term basis with the anticipation of paying those funds back within 3 years without paying any penalties. So those were two big ones. Some other things for those that have unfortunately lost their job, they've extended unemployment benefits. So there's an extra $600 a week available in unemployment benefits for those that lose their job. Yeah. So those are some of the big ones that were part of the CARES Act.
Yeah. And I think that we hear a lot, this is what's hard too, is that with the COVID-19 coronavirus, we're hearing a lot of things as it's coming out, and we have to wait to get the actual information maybe a couple of days later, because a lot of what we're hearing is so highly emotional. Like Shake Shack took all this money, and Ruth Chris took all this money that's supposed to be for small business. Now Shake Shack is giving money back. Ruth Chris is not necessarily, and so it's interesting watching the news unfold as it's actually happening.
Oh, I know.
Yeah. And we're still hearing stuff about the original CARES Act that people or big businesses are actually able to still tap into it when it was supposed to be for small business. So this extension that they're mulling or they're trying to pass right now, I'm kind of curious to see where that ends up. And the $1,200 it went to a lot of people. It's not done, of course, but it's people are still getting their checks, hopefully. Yeah. So what should, and this is a very general question, right? What should people be doing at this moment? When it comes to the market, if you're not the best or most savvy investor, if you have money to invest, should people be jumping in? Should people not be jumping in? What would your general advice be, other than be careful?
Yeah. Okay. So this is one of the things with investing. Let's take both sides of this. Say you're thinking about getting in. Let's say you're already in. Uh-huh. So oftentimes when you're in the market, as painfully challenging as it can be at times, often it's best to just do nothing.
Yeah.
With investing, is as difficult as it is, you feel like you need to do something, whether that's get out of harm's way. That's extremely challenging because investing is ultimately extremely emotional. And, our behavior, human beings, we are wired to run away from fear. I mean, we're wired to run away from fear. So when you see fear in the form of red ink, or losses in your portfolio, you want to run in the form of just getting out and selling.
What is that? Sorry to interrupt, but isn't Warren Buffett's famous saying, the stock market is the transfer of wealth from the impatient to the patient?
That's one of them.
Yeah. Yep. And many others, but
yeah, that one, I love that. And be greedy when others are fearful, and fearful when others are greedy.
Yep, exactly.
So as difficult as that may be, it's something that has held true for a very long time. Now, what I was going to say was, it's easy to say, let's get out of harm's way, right? In the form of liquidating stock positions and just sitting on cash. And I hear it a lot. Why don't we just, let's just sell now and wait for things to kind of work themselves out or iron out, and then we'll get back in. Basically what you're saying is that you're going to sell low and you're going to buy high. That's in essence what you're locking yourself into doing.
Yeah.
And the hardest part, it's easy, to get out. The hardest part is getting back in, making that decision to get out. Okay, that's one thing, but being right twice and saying, okay, this is the time to get out, to get back in.
Yeah.
Because what happens with investors is that it may be a good time to get in, fundamentally speaking, but I am assuring you that it is not going to feel good to try to get back in. So oftentimes the best thing is to just do nothing. If you did need to do something, maybe you consider peripheral change, something around the edges, just to kind of scratch the itch a little bit, as opposed to completely doing a 180 and getting out. So that's just, one other thing on that is on the behavioral side, because that's something that I'm intrigued by, is just the behavioral finance side of financial planning and investing, is that as human beings, back to that fear thing, is that we hate losses twice as much. And there's actually some studies that say it's even more than 2 times, but we hate losses twice as much as we get joy from gaining. So we hate losing money in the market. Yeah. Just what it invokes in our brain. We hate that twice as much as getting our statement in the mail and seeing that our portfolio increased by 10%.
Yeah.
So there's the behavioral side of it is very fascinating when it comes to investing. So what should investors be doing now besides, sitting on their hands? I would say you need to go back and you need to reassess your plan. If you do have a plan, you need to look at whatever it is and say, are we still on track based on what I put in place a year ago or 2 years ago? So let's just say somebody that is not retired. Let's take a 50-year-old that plans on working for another 10 years. They want to try to retire early at 60. What they should be doing is they should go back and assess, are we still on track to hit this goal of retiring by age 60? And if they're unsure, obviously you could reach out to a financial planner and start that financial planning process, or maybe you need to reassess things. Do you need to increase your savings rate? Do you need to rebalance your portfolio? Because one thing that you could be doing in this environment, there's a couple other ideas. So rebalancing, we can talk about that for a second. What is rebalancing? So when you have a portfolio let's just take the standard portfolio that's invested in stocks and bonds. Okay. So the bonds are in there for diversification. And let's say you have stocks that are invested globally. Now, rebalancing basically involves selling the stuff that has gone up in over the last month and a half. Your bonds may have gone up, and buying more of the stuff that has gone down, which would be your stocks. Yeah. So if you rebalance into the volatility, so as the market is going down and you're seeing your stocks drop in value, what you do is you actually end up buying stocks through a rebalance process and you sell your bonds. Because what's very important is for investors, if you had a plan and you had a portfolio that you were invested in a year ago, and today that portfolio is not aligned, and more than likely it's not aligned the same as it was a year ago, you may want to consider balancing back to the original intended targeted allocation of 50% stocks, 50% bonds. So that's one thing. Another thing that you could be doing if you have a taxable investment account, maybe it is a trust. Hopefully it is registered in a trust. But you can do what's called tax loss selling. Basically, if you have an individual investment, whether it's a stock, a mutual fund, or an exchange traded product, and it's down in value from where you purchased it, you can sell that investment, realize the loss, and invest the money in something not exactly the same, but maybe something that's similar in nature. Yeah. And realize the loss on your tax return. Okay. And so that's a way to save some money on taxes. Another idea, one more, is what is called a Roth conversion. So this is, I would imagine, if we look at what's occurring with the stimulus and the debt, and that's a whole nother conversation, but one has to assume that at some point in the future, tax rates are going to be higher than they are today. I mean,
Yeah.
it's speculating, but my thesis is, there's a lot of solid data behind an expectation of higher taxes in the future. So you have an opportunity if you have a pre-tax IRA or an IRA or that has not been taxed because you took a deduction when you put the money into the IRA. You can today convert or move those dollars into a Roth IRA. And the reason why that may be beneficial for somebody is because you end up paying the tax now at the time of the conversion. And the beautiful thing with Roth IRAs is that you pay the tax at the time of the funds going in, but you never pay tax again. So if you move, let's just say $1,000 into a Roth IRA, you pay the tax, and then let's say that $1,000 grows to $1,500, and you're retired and you need to take some money out of your retirement account. So the $1,000 tax-free, the $500, the earnings, as long as you meet certain criteria around Roth rules, the $500 in earnings is also tax-free.
Okay.
So you could have, as a part of your retirement income plan, these different levers. You could have a taxable lever, so like a trust investment account. Maybe you have an annuity, or maybe you have Social Security, a pension. You can have a pre-tax IRA, and you can have a Roth IRA. And the Roth IRA, 100% tax-free. So the reason why that may be beneficial today is, number one, is because of the tax rates, favorable tax rates today. And number two, many people's portfolios are down in value. So you can convert while we're down temporarily and convert more dollars, basically, right? Because of the drop in value. And then you can experience the rebound that eventually will come in the form of tax-free.
Yeah. So ultimately what it comes down to, it sounds like, is speak with a financial professional like yourself, because it is a lot to wrap your head around. Even as someone who works in the planning side, on the legal side, I am still very interested in this. We talk about this kind of stuff all the time, but it's still a little bit confusing for me. So the main thing is, talk to someone, make sure you have a plan in place. Not only do you have a plan for your trust, for your assets, but make sure that you have your financial side in place too, so you can retire and hopefully stay on track, because this is throwing a wrench in a lot of people's plans. If you had a plan, if you didn't have a plan, you need to put one in place, and you need to do one right away too. So Joe, why don't you go ahead and put your information out there? We're going to put this in the show notes as well too, in case anyone wants to call you or email you. And are you doing can you do consultations for people or something like that?
Yeah. And even if you have somebody that joined this webinar that just wants somebody to talk to, maybe you're not quite ready to commit to a plan, or maybe you have a friend that lost their job and just has some questions about, what do they need to do? I'd be happy to jump on the phone for 15, 20, 30 minutes and just give you some feedback. Pro bono, I'm absolutely more than happy to do that.
Okay.
And then if you feel, you as an individual, you feel like this is, because oftentimes with financial planning, there's oftentimes a life event that occurs where you say, I need to do something. You don't wake up in the middle of the night and go, I think it's time to put together a financial plan. That normally doesn't happen. It's somebody gets sick, or it could be a number of things. And this is actually a situation that we're experiencing today where some people may be, driven to start that process. So, but yeah, you can reach me. Probably the best way is I'm working from home right now, so I could put my email address. Put my email address out there. So it's Joe my last name, Stenovec, which is STENOVEC at LFA-INC.com.
Yeah, we'll make sure to put that into the notes too, so people just can click it, because it sounds like a lot of stuff there. Yeah. Well, I appreciate you coming on, and I don't know if we have any questions from any of the attendees on the webinar. I don't think I had any questions come up on the Facebook. We didn't really mention that we'll be taking questions, but if anyone has more questions, we'll be sure to pass it on to Joe so he can answer them for you. Also, you can email me, justin@lawyerinbluejeans.com, and I will pass it on to Joe or try and answer your question as best I can. But if it's financial in nature, I will definitely be passing that on because this is not my forte like it is yours. I did not go to the extra schooling. Any last words, any tidbits of information you want to throw out there before we let you go?
I would just say be patient, and this too shall pass. You just have to believe that on the other side of this, there's opportunity, and just be patient and just stay safe.
Yeah.
And that's about it.
Well, thank you for joining us. And I think we'll probably try and do a recap in the next couple of weeks. We'll have you back and discuss a little bit of the market at that time. There's a lot of good information in our fields, definitely cross paths, and people want to know and a lot of times we want to know the easy answer. What should I do?
Yeah.
What should I buy? And it's not so easy all the time. And that's one of the important things that you're always telling me is that sometimes you got to just wait and you have to, bide your time, especially in a time like this, because there's so much uncertainty. We just don't know exactly what's going to happen. So we'll make sure to definitely have you back on to discuss this a little bit more. But thank you very much for joining us. We really appreciate the information too. Yeah. We will be doing another webinar on Thursday with Brad Seaman. He is the Seaman Team Realty with Keller Williams. We're going to be talking about the real estate market. That's going to be Thursday at 1 o'clock. So make sure you tune in. And we'll be putting this webinar with Joe back out there. So in case you want to rewatch it, it's also on our Facebook. So if you're watching this on Facebook Live, make sure to give us a like or a share to send it out to all the other people on Facebook. I don't know how the algorithm works, but just click a button and it goes back out there. So thank you, everyone, for joining us. This is Justin Isaac with the Lawyer in Blue Jeans Group, joined by Joe Stenovec, Certified Financial Planner. And stay safe, everyone, and we'll talk to you soon.
Thank you, Justin.
Thank you.